Big down day in the market today, guys. The NASDAQ finished down almost 3.3%. The S&P was down over 2%. NVIDIA, big time down day. Remember, guys, this is not a knock on NVIDIA. Whatever companies lead the Dow up in Magnificent Seven, or not the Dow, the NASDAQ markets are going to lead it on the way down. Ironically, though, Tesla did not have a bad day today. The Dow hurt pretty bad by Intel. Last week, Intel was up big at the end of the week because of some new decisions on cost cutting, what they're going to do. Today, pulled back a little bit more, a lot more, 8.8%. So the reason the market was down today, the manufacturing index came in lower. Now, guys, manufacturing as a percentage of GDP is down from a little over 15 or 16% in the mid-90s to about 11% today. Now, but if you look at what the total dollars spent on generated on GDP from manufacturing, it's up since then. The reason I bring that up is to remind everybody that a declining percentage can still be an increase as long as the pie is getting bigger. So even though the piece of the pie in manufacturing occupies is smaller and smaller, it's still a growing piece because the bigger pie is getting bigger and bigger. The US economy is getting bigger. You have to remember that. Now, I also saw people saying, this is great, this is wonderful. That means rates are going to be cut. But as you remember in all of our videos here, we always talk about rates being cut may be a sign of bad things. If you look at history, we made a video last week on our main channel. If you look at history, when rates are cut, it's usually either right before or right after recession is called, okay? So you got to remember that cutting rates is all about spurring the economy to grow, not just, oh, we hit our inflation number, we're good. It's about spurring the economy. Manufacturing being down, our consumers being more hesitant. I've said this over and over before. Now, it's not to be a fudster. It's just to say we go through cycles. What we're trying to teach on this channel, and by the way, if you like this channel, it's a 24/7 Everything Money channel. We make 4 or 5 videos a week where we go over economic news, earnings releases, general news about the market, quick recaps. If you like it, do me a favor, subscribe to the channel. If you like engaging with people and me on these kind of topics, follow me on Twitter at EMPaulG. Again, that's Twitter at EMPaulG is my name. I'm very active on there. I do a lot of polls, so please follow me there. But guys, these are all what we're trying to do in this channel is teach people that no matter what's happening in the economy, ups, downs, left, right, if you pay a good price for a great company, you'll probably do well. Does that mean the stock won't go down? No, it is going to go down. That's a reality of stocks. When the market falls, it's hard that for everything not to fall with it. What's going to fall the hardest are the most hype, the most euphoric stocks. Tends to be the Magnificent Seven. You saw what happened with the Mag 7 and FANG stocks back in the 2022 bear market. They fell a lot harder. The NASDAQ fell a lot harder than the S&P. Overvaluation, when things are pulling back, will fall the most. That's okay, though. What we're here to do is teach a process for you to pick the investments that work best for you. Now, in this economy, we're running a lot of great news recently, but we had an inverted yield curve back and forth now for over 2 years. I think it was the longest one ever from July 6th of 2022 until recently it re-inverted back. Does that mean the recession is over? Remember, they call recessions after the fact. The SAM rule got triggered recently because the unemployment rate was 0.5% or more greater than the low of the last 12 months. So the last 3 months average was 0.5% greater than the low of the last 12 months. Again, these are all things, but it's to mean that this is an opportunity for you. We want to teach about that opportunity. If you've heard this 1,000 times, hear it 10,000 more times. This is a reason why baseball players, basketball players, all athletes practice the basics, about repeating these things over and over in your head. When the stocks you love and the companies you love start to slip because of the economy, that doesn't mean you bail on those companies. It means it's an opportunity for you to buy great companies at better prices. Because remember, as Charlie Munger says, when there is a recession, these companies get smaller and smaller, and they're compacting their spring. But the second that economic release happens, the stocks will skyrocket, profits will skyrocket. You don't know when it's going to happen. So your job is to keep buying great companies at better prices. That's why the tools in our community allow people to make those decisions even better. So guys, when it comes to all this data out there, today the excuse was the manufacturing index. tomorrow there might be a surge. We don't know what's going to happen on any given basis. What we do know is over long periods of time, we're still at historically high valuations. I believe as of yesterday's update that I did in our community, we're at 109% overvaluation on the stock market GDP ratio, and we're at 110% on the 10-year cyclically adjusted PE ratio. Either way you look at it, it's 110% overvalued, which means fair value in the S&P right now is 2650 to 2700. Does that sound scary? It shouldn't be. I understand why it feels that way, but you look at the past, we've had many falls of 50% or more. And guess what? We always get better. The economy recovers, stock markets recover, we go to newer highs. That's why dollar cost averaging is very, very important for people to understand and do at all times. So guys, 2 things I need you to do. Subscribe to this channel if you want these quick updates. And second, follow me on Twitter at EMPaulG. Thank you for your time.